Okay, so here's something a little bit different today. I'm going to be explaining what I've learned now from month 1 of the core content all the way to month 3 of the core content before we keep going. And this will probably be slow. I may have to go back and forth. All right, but this is ultimately for my understanding and for my active recall, or therefore being able to recall that information. Okay, so we're going to be going over what was covered in month 1 and just some of the major concepts. It's a summary, it's not a detailed description of everything, although on a couple of the concepts I've learned, they are a little more detail specific, so I will elaborate on those as I have taken the time to memorize those concepts. So in month 1, he goes over the interbank price delivery algorithm. Okay, now he also goes over premium to discount, and he speaks on what you should focus on now. There's a few key points. The first of which is that in markets that are in consolidation, from a consolidation, we always expect a expansion. It's never consolidation, reversal, or retracement. It's consolidation, expansion. From expansion, we can see another consolidation, a reversal, or a retracement. Now, he also talked about how those concepts go hand in hand with different other ideas. So the first we'll start with is consolidation. A consolidation is going to go hand in hand with equilibrium. Okay, let's go over a reversal. Okay, so a reversal is going to form with a liquidity pool. That would be relative equal highs, and that's going to be like the turtle soup kind of thing. Okay, now liquidity voids go hand in hand with reversals. So if you see a reversal, it's going to be filling in a liquidity void. One I'm forgetting here. Oh yes, right, expansion. Expansion, order block. When you see an expansion, you're going to look at the consolidation, you're going to look at the last down close before that formed, and then when that was violated, and you're going to expect price to reasonably trade back to that order block. As far as with discount to premium, what was really mentioned, or just to simplify that, he talked about going on to higher time frames, and I want to reiterate on that, higher time frames, okay, to measure impulse price swings from a higher time frame to a lower time frame. Okay, so we use an impulse swing we see on the monthly to see if price is in a premium or a discount. The understanding or the idea or the reason it was taught is the very first thing. We know that markets, or I guess I should say market makers, okay, market makers are going to look to sell their long positions in a premium, meaning that their positions they got in at a low or at a previous low that will be sold in a premium. A premium would be measuring the high to the low of the most recent price leg, okay, and above equilibrium would be your premium, okay. Now at equilibrium, that is specifically fair value. There's different forms of fair value as well other than just equilibrium, one of which being a return to displacement, or therefore rebalancing a void. That would be a return to fair value when it rebalances an inefficient range. Okay, but that was one of the other things I wanted to go over as well. As for anything above equilibrium, from the 62 to I believe it's 79, I have it on my trading view, I don't know the exact level, that's optimal trade entry. And so what it really is a indication of the market, first of all, being in a deep premium. So we can look at that and reasonably expect prices to go lower without picking highs. Of course, we would refine these ideas of a higher time frame premium being met, higher time frame optimal trade entry. We would refine these ideas on lower time frames. Okay, so that's really what my main takeaways were from month 1. I don't think I'm forgetting anything on that. Pretty self-explanatory. Now, month 2 was a lot of mindset oriented concepts. And he talks about defining risk. He talks about how less doesn't necessarily equate to more. He talks about how traders build 10%, or how large fund traders build 10% per month. He talks about risk management. He talks about how to mitigate losses effectively. He talks about why you shouldn't fear loss. And I think I said this, but I want to just say it again. Risking more does not therefore mean more profit. He talks about framing your ideas, and he also talks about the accuracy that you need to see to see profitability. So, another thing he went over, which I've gone over in a previous video, is our process-oriented thinking as a trader. All right. So we're going to start from the bigger picture perspective. Okay. Now, the bigger picture perspective is what is going to be used, obviously, for the bigger picture, or to get an idea on where the market is going. All right. For it to be valid, we need to have at least two of these ideas in alignment with each other. All right. So this, bear with me, I'm a little, rocky on this. I'm going to try my best, but the first thing is going to be the interest market. Okay. The other one is going to be here's the other one. Intermarket analysis, seasonal tendencies, and the macro. That's the other one. Macro. Okay. Now, our intermediate term perspective is going to be the same thing. We need two of the ideas to be in alignment. It's going to be COT data, market sentiment, and top-down analysis. All right. The last one is going to be correlated pair analysis. So the study. Sorry, let me just back up. This last one is our short-term perspective. The first thing is going to be correlated pair analysis, or the study of pairs that are correlated. The second one is going to be time plus price theory. All right, which I have, more to learn about that. And I'm having a brain fart here. What was the very last one? And this is going to kill me. What is the last one? The last one is IPDA, Enterprise Delivery Algorithm, which we use on a short-term, or we use for our short-term perspective. Okay? So this would be our process-oriented thinking. We would start from our bigger picture perspective, make sure we have two of those that align. Okay? We would then make sure two out of our three, on our intermediate perspective align as well. And then lastly, just wrapping up, for our short-term perspective, we need all of those to align. All ideas for the short-term perspective, all three concepts need to align. Okay. So I'm not going to look at my notes. I'm just going to look at the titles, actually. Let me make sure I didn't forget anything for month 2. Second here. I don't believe I did. Let's see. Okay, and then additionally here, one thing that I did forget for month 1 is he talked about low resistance and high resistance liquidity runs. So the idea behind that is, in a price run lower to a specific level, you would be anticipating price to create lower highs. And so trading against that would be high resistance. Now, in a time where you have a immediate down movement, so you see very quick down movement, or an inefficiently traded range where there's just a lot of, we'll say black candles and no green candles, that means it's bearish very quickly. Trading back into that range would be a low resistance liquidity run, as we would be expecting price to fill in that void or gap in liquidity. Okay, so that's something I want to mention as well. Additionally, when it gets to the top of that range, like when it rebalances it, that would then go back to being a high resistance liquidity run, and we would reasonably expect the market to consolidate. Okay, so here we go. Just want to say that, no fear of losing. secrets to high reward trading setups. Oh, right. Okay. He also went over the market maker, two different false patterns that retail traders use that will form in the market. One being false flags in the form of a bear flag or bull flag, which is seen as a continuation pattern. He does mention that it does repeat, but a lot of the times the logic behind it is flawed because people will be looking for these patterns when a trend or a range has matured. From there, when the range has matured, it is no longer a continuation pattern. You would then anticipate this pattern to be actually a reversal or to continue in the other direction. All right, now he also talked about a false breakout. A false breakout being a false breakout from a consolidation range. And I will say that originally this had me a little bit conflicted. And the reason why is I was thinking, if I'm looking at a consolidation, how can I reasonably know if it's a false breakout or if it's a real breakout? How do I know? Well, the first thing is any breakout of a consolidation, as we know, should be met with an expansion. Therefore, it's going to be met with aggressive movement. When we're in consolidation, we're going to have orders accumulating on both sides of that. So we're going to see sell side and buy side. We're going to see relative equal highs. So when we have that false breakout, it's just simply wiping. We'll say it's on the false breakout is just on the sell side. Well, what we classified as a false breakout is not seeing that aggressive movement, not seeing, price show a willingness to expand from that. All right. That's what we would want to see if it was an actual breakout. If it's an actual breakout of that consolidation range, we want energetic movement. So those are the two patterns that he went over there. So that's good rough ideas for both month 1 and 2. Okay. And there's a lot more to this that I'm not explaining, but I'm just explaining roughly what the lessons are and what they've been about. And so that way I can continue building on my understanding. But anyways, let's get into month 3. So month 3, video 1 was a banger. Okay, I'm just going to say that. He goes over time frame selection, so essentially how to select the right time frame, and additionally how to define your model. And he talked about, I don't think it was in this video, but he, talked earlier on, he talked about how defining your model is how you graduate, right? And so the defining your model portion of the video is really just him talking about finding the signatures that stand out to you the most, okay? That is going to be your model. So say for me, it's what stands out the most is always that, consolidation, return to an order block, and then seeing price continue in that direction, right? That could be my model. I'm not really sure what my model is. I still have to do a lot of testing. In fact, I have to implement these concepts to a lot of back testing, but let's not get into that yet. Time frame selection. So here's the second part that I'm going to have to reiterate on or explain because it's very thorough. So for time frame selection, you have 3 different options. Position trader, very long. You're going to trade directly off the monthly. Okay. You then have a swing trader be on the weekly. All right. And lastly, short-term trader, okay, which would be the daily. Now, he also explains 5 different trading styles. First is the trend trader. The trend trader is going to trade off of the overall direction of the market, and so therefore it's going to be a high time frame idea, okay, being off of the monthly and weekly. All right. For the second one, which is a swing trader, okay, so a swing trader is going to be trading off of the weekly chart, looking for intraday price swings, or sorry, not intraday, intermediate term price swings. Okay, that's going to be your swing trader. Your next one is going to be your contrarian trader. For a contrarian trader, you would expect, or you would look for market extremes, being market extreme high, market extreme low, okay, and then from there you would be seeking reversal patterns. Think of relative equal highs being taken out, or a turtle soup, okay, and afterwards expecting price to go in the opposing direction. All right, so now we're going to talk about a short-term trader. Short-term trader is someone who trades the weekly range, 3 to 5 day range, okay, and a day trader, which is also a short-term trader, okay, but a day trader is going to trade intraday price action, all right, and the position is going to be closed out by the end of the day. That in mind, now that I know those criterias, I have to define what specifically that is for me, okay? So let's go ahead and move on to video 2, which was about institutional order flow. I'm just going to keep it really simple. Video 2 was essentially elaborating on what was taught in month 1, which was what to focus on now, okay? He went more in depth to those ideas. He explained how for every, I don't know if it's in this lesson per se, but he explained how for every green candle there should be a black one, or for every bearish candle there should be a black one, okay? That may be part of the next lesson, so I don't know exactly, but nonetheless, institutional order flow is simply just relative equal highs. It's where price showed a quick movement from a specific level. It is large displacement or energetic movement. And it's the paradigm of looking for where majority of the liquidity is. Video 3 was about institutional sponsorship. And institutional sponsorship is very similar to institutional order flow. The definition, I believe, is something, roughly along the lines of the impact of large funds entering in the side of the market that you were anticipating price to draw to. And he explains how, for every green candle, there must be a black candle, which, so I believe now that was taught in that third lesson. But additionally, he explains how on large time frames, such as the month and weekly, we need to understand that for it to move from level to level, that there has to be large money or large funds driving price to those levels. Video 4 was about anticipatory skill development, and he essentially teaches you how to define the monthly range from the most recent order block on the monthly chart, so the most recent up close candles low and the most recent down close candles high, drawing out a line in between that from that high to low, then dropping down to a lower time frame to refine that idea more and more in depth. So video 5, he went over SMT, and he also went over inverse relationships, market structure. So this video, how there is an inverse relationship between US dollar and foreign currencies, and how they are opposed to each other. He tells you directly to measure impulse swings and compare them to measure impulse swings and then compare them to measure impulse swings, and then you are going to compare your impulse swing on, say S&P or the NASDAQ to the US dollar. And you're going to make sure that those swings are the same. For this, you would expect if S&P makes a high and then a higher high, you would expect the US dollar index to make a low and then a lower low. If this doesn't happen, this is showing accumulation. Accumulation would be if we have, say, the NASDAQ trade that lower low, so we have the NASDAQ create a low and a lower low, okay, that's run below an old low, so sell side liquidity was taken. Let's say we see that the US dollar has created a low and then to the right of it, or sorry. Say it created a high, and to the right of it, we then see a lower high. We would then see that as a form of accumulation, and we would see the US dollar is showing weakness, and being that it's showing weakness, we would look to see higher prices without picking highs or lows. And video 6 was essentially the same thing, but he explained, and he explained it more for Forex, but he explained how to use the bond, the T-bond and T-note 10-year and 30-year treasury markets, and how to use their relationship against the US dollar. And so when we're expecting higher interest rates, we'd be expecting lower prices on the dollar. And when we're seeing the opposite, so when we're seeing lower interest rates, we would expect the dollar to go higher. So we can then use that information for our futures contracts, and futures contracts are going to be oppositional to the US dollar. So if the US dollar again is trading higher, then we would anticipate that trading lower. And it's the same concept, but that is micro to macro analysis. That's what that would be called, using interest rates against the US dollar, and then using that on what would be, using that for futures. The last two are really simple. He talked about trendline phantoms, and he talks about head and shoulder patterns. So he talks about the issues with trend lines, and just how they're not probable. It's not good probability. There's nothing probable about them. The market does not react based on a line that you draw on your chart, but he does explain how we can take advantage of a trend line. So what we would do is we would use our higher time frame points of institutional order flow, and would know where those reference points are. So say we have traded close or near to a, we'll say, bearish order block, okay, on the higher time frame. So we'll say a daily chart. So we see price trading to our higher time frame refined order block, but we see a downtrend on the 15-minute time frame for whatever pair we're looking at. If we were reasonably expecting prices on our higher time frame charts, meaning we're expecting price to continue higher, we would look between, in this case it would be a uptrend, or downtrend, sorry, it would be a downtrend, between the second and third high and lower high of a downtrend. We would seek any movement below the low in between as a buy opportunity, being again that our higher time frame analysis aligned with it. It's the same thing for a head and shoulders, but a head and shoulders is a little bit different. A head and shoulders is going to form, we'll say, we'll use the same idea of us trading to a bearish order block on a higher time frame. A head and shoulders would be a high to the left, a higher high in the middle, and a high, or sorry, lower high then to the right. Now, between those levels, we would have a neckline, and most people would wait for a breakout below the neckline, expect it to retrade to the neckline, and then it would be a continuation pattern lower. We would see this as a reversal pattern, again, just focused on where we are on those higher time frames, where we are in institutional order flow, and then we would anticipate the opposite. So when retail would see a just normal head and shoulders, and they would see it selling lower and then returning to the neck, they would see that as price continuing lower. And depending where we are on our higher time frame chart and what we're anticipating with our directional bias, we would then seek the opposite if we were going to use that concept and use that to our advantage. That said, that is a good, it's about a 30-minute video. I didn't think it was going to be this long, but that's just a good basis on what I've learned so far. If I ever get caught up, I will refer to my notes and refer to this video to understand what I've learned and what's been taught so far.